Welcome to Active Investing in Trump's New World. My name is Chris Kumi, and I'm known as the Business Godfather, and I've established ActiveInvestor.us for people who are interested in getting more out of their assets and getting the most as an active investor out of the world. And with Trump coming into office, I got a lot of questions from people about where is the best place to put my money? How can I start positioning myself to take advantage of these major changes coming? And for me, my wife very rarely asks me questions like that. She's busy with her own IT company, and even she came to me to ask about what are the opportunities. And so one of the things I did is I did an analysis of what Trump proposed, and what I've done is looked at what others had to say and put that together here in this presentation. So basically, what I've given you is my own evaluation of where the best opportunities are going to be over the next 3 to 5 years. And my background is I'm a business attorney by trade. I've helped IT companies grow, and right now I'm a private investor where I work with startups, invest in some of them, and I have about 10 companies that I work with on a regular basis. Part of my background is when I was 19, I started my first business. And that was a simple coffee shop. But basically, since then, what I've done is I've opened up businesses and helped other people open up businesses. And that's where I developed the perspective of the importance of being an active investor. And we'll talk some about how we need to start transitioning away from the passive investing perspective into a more active approach. And so what I've done is I've structured my personal business with active investing as my overarching approach, basically my focus area of what it takes to be successful going forward. And so we've established an active investor group on LinkedIn. We have ActiveInvestor.us, where you can get some of my thoughts as to what you need to be looking at to be successful as an active investor in the current environment. I also work as the Business Godfather. I have a number of business owners that rely on me to help them grow their business. And through the Business Godfather, I work with startups, help them to refine their business model, help people develop cash flow businesses, and also help others develop intellectual property that they can leverage and use to generate additional cash flows. One of the companies I work with is Ally Homes, which is a home remodeling company based in the DC and Baltimore area. And Ally Homes is there because real estate is also a key part of an active investing strategy. And so having a home remodeling company is essential as we look to enter into real estate opportunities. And Online Trading Academy, I am the franchise holder for the Online Trading Academy for Washington, D.C. and for Baltimore. And the Online Trading Academy is a school that teaches people how to trade and invest their own money. And I see this financial trading as one of the key business models you can use as an active investor. And we'll talk about it a little bit more, but the 5 models that we rely on as active investors is 1 is startups and angel investing, 2 cash flow businesses, 3 intellectual property development, 4 real estate, and 5 financial trading. And so as you can see, I've structured my personal business in a way where I'm able to take advantage of these 5 different business models. And for you, that's something for you to consider. How can you take what you've got and start using it to establish more businesses? And for me personally, I just came back from a trip to Greece. One of my best friends owns a business, and Greece, the economics in Greece are awful right now. With austerity, they've lost their hope and confidence. And he, as a business owner, has watched his business, which was extremely successful, has continued to slow and to shrink over the last several years. And so one of the things I'm working with him on is to get him to use the cash flow from this existing business to start funding additional businesses that will allow him to get growth in his personal financial structure. And that's where I challenge you. If you're a business owner and you have only one business, you need to start looking at how can I start developing multiple streams of income through multiple businesses. And one of the challenges with Trump coming in is there's massive change coming. But one of the things we know is that change happens, and people are uncomfortable with change. At the same time, with change, there's often great opportunities. And I have here a quote, success occurs when preparation meets opportunity. And so this presentation is basically to help you start getting prepared and start thinking bigger about your personal business and the opportunities before you. Because with the Trump administration coming in, just by mentioning the name Trump, if you're for Trump, people get upset that you're talking about Trump. If you're against Trump, people get upset that you're talking about Trump. So he's an incredibly polarizing figure, but he's in place and he's in position to propose a lot of pretty radical change and assaults on the existing system. And so as those assaults happen, those who stay still, those who stay doing what they're doing are going to be hurt. And what I'm trying to do is make it so that you don't have to get yourself hurt by continuing to do what you've been doing. In a time of massive change, you need to start looking at how can I take advantage of the acceleration that's going on. And so my mission is to help you deal with that change more effectively. And so there's three things that we're going to talk about here. One is get you to realize the magnitude of the change by what the Trump administration is proposing. Because there's a lot of people that are looking at this as, well, this is just business as usual, or that's just politics, that doesn't impact me. And they're going to continue on with their passive investing strategy. They're going to continue on with the business that they've been doing. And that's a big mistake for folks these days. I just read a book called Thank You for Being Late by Thomas Friedman. And Thomas Friedman had written Flat, and he's a pretty good chronicler of what's been happening during the 21st century. And one of the things that he points out is that we are in a thing called the age of accelerations. Is that things are dramatically different, and things are changing so rapidly that if you continue to do the same thing, you're going to be passed by. And he's talking about the different forces of change, and Trump is a force of change. And the U.S. has basically built the world economic system the last 70 years. And it started after World War II, and certainly over the last 30 years with the fall of the Berlin Wall, the breakup of the Soviet Union. At that time, we had this massive change. People were expecting that we break up into what they called a multilateral world. We'd go from a bilateral world to a multilateral. The reason that over the last 30 years, what's been created is a unilateral world with the U.S. in the middle. And what's challenging is the preeminence of that unilateral approach to the global economy. And it's going to have significant impact on everything you're invested in. It's going to have significant impact on your businesses, and everything that you've taken for granted up to this point is going to be different in a short amount of time. If it has to change, it's going to. And so I recommend the book to Thank You for Being Late. And for those of you who are listening to this, you're not late, so thank you for being on time, but get that book. It'll be a great read for you so you can start understanding some of the power and the potential of what's going on. So the first step is to understand the magnitude of the change. My second mission today is to get you to understand what are the key factors I need to focus on to understand what I need to look at to change. And part of it is to recognize the timing and magnitude of the opportunities. The timing and magnitude of making this change has great impact on your ability to benefit. So it opens up your eyes to where the best opportunities are going to be. And everything that's been happening over the last several months, this week in particular, talking about down the government, putting out a tax plan, changing health care, talking about infrastructure, all those things are important. The key is the timing and magnitude of those. keep our those things, then what I want you to do is really prepare to make more money than you've ever made. Because in this time of massive change, those that are prepared are going to be able to experience enormous success to take advantage of these, put their head in the that are basically continuing to do the same thing. You may, make a little bit more money, you may not, but get of how do I take what I'm doing now and use it to fund additional income streams and wealth opportunities going forward. So here's our agenda. And so we're just in the process of getting started, understanding what we're trying to accomplish. Next, I'm going to go into the U.S. economic outlook. And that goes, what I did was I went out and looked at various opportunities, various sources to see what did they think was going to happen before the election, but then also after the election. Then what I'll do is I'll go into what others were saying based on the Trump administration coming in, where they thought the opportunities were going to be. And then more importantly, we're going to take a look at what the financial markets have actually told us. And the financial markets give us real-time information as to where the big money thinks the opportunities are. And then we'll get into how do you balance these different policies, the inflationary policies in a deflationary environment. And that's really the struggle. That's the push me, pull you of all these policy discussions going on, of how is it going to impact, and it goes to what I was talking about earlier, the timing and the magnitude of these proposed policies. Then what we'll take a look at is the active investor opportunity areas that I've identified for myself and I'm sharing with you so that you can take advantage of the opportunities that surround us and that Trump is going to open up for us. And then I'll introduce you to my active investor framework and how do I apply that to start looking for the opportunities, but more importantly, how do I execute on those and how do I pursue a strategic action plan that allows me to get the benefit of these opportunities. And so as we do this, you have an opportunity to ask questions in the text box. And so at the end, I'll go through the questions that are asked, and that way you have an opportunity to have those, those things answered. And so as we do this, think about how is this going to impact you, and more importantly, what are you going to do about it? Because at the end of this, if you enjoy what I talk about and you send me an email or text that says that was really interesting, then I failed you, okay? Because I'm not trying to be interesting, I'm not trying to be entertaining, I'm trying to help you make more money than you've ever made in your whole life. And what I want to know is, what are you going to do about it? What action are you going to take to start taking advantage of these opportunities? So throughout this presentation, I want you to be active, I want your brain to be activated, and I want you to start thinking bigger and recognize the opportunity before you. So the U.S. economic outlook before the election, and remember, before the election, everyone was expecting it was going to be business as usual. It was going to be no major changes. And so the expectation was that, from now and for the foreseeable future, 5, 10, 15 years, the U.S. was going to experience a slow growth economy. And a lot of that is demographic. A lot of that is based on some of these changes that have happened in the 21st century. That's why I recommend those Thomas Friedman books to you. And the expectation is a 2 to 2.2% growth for this year, and over the next several years, 1.6 to 2.1, 2.2 over the next 3 to 4 years. So really pretty average, mediocre, nothing special growth expected. Some were expecting that in 2017 there may be a possible recession because there was some indication that the economy may be slowing. Now, after the election, the sources basically they didn't make that many major changes in their expectations. We are still in a slow growth environment. The demographics are still established, and so in order for us to break from those demographics, we need some major innovations. We need some major changes in how things operate. and they may present themselves, they're not going to come from government policy. Now, the range for 2017 was ticked up a little bit, 2.1 to 2.4%, but still not outlandish, not expecting significant growth. And even if you look at the range for 2017 to 2020, while there's been people that are projecting 3%, 3.5%, 4% growth, none of the economists, none of the people that actually live and breathe this stuff every day believe that that has any reasonable basis and is even achievable by the U.S. economy the way it's set up. And so in that environment, we need to be positioning ourselves to take advantage of it. Now, at the same time, they're expecting that with the policies that with Trump coming in, that'll probably delay a possible recession. We've already had an extended period since the last recession in 2008. So here we are 9 years. So this is saying that maybe we'd extend out, 10, 11 years between recessions, which is an extremely long time. The challenge for you is to say, with these changes, there's going to be some aspects of the economy that will slow significantly, others that are going to accelerate. So part of this is getting you to position yourself towards the accelerating portions of the economy. Now, the major things for the U.S., and this goes to that second point of getting you to focus on what are the things that matter based on Trump's policies. And the three primary positives, one is fiscal stimulus from infrastructure spending. And the number that's been thrown out there is $1 trillion, which is pretty significant. The U.S. the U.S. economy is about a $19 trillion economy. And so, adding $1 trillion to that is basically, a 5 or 6% boost. And if you do that over a couple of years, that can get you, 2, 3, 4% growth, provided that that $1 trillion was not going to happen anyway. So the fiscal stimulus for infrastructure, depending on how that's structured, could add on, 0.5% or 1% per year, which could get us into these higher ranges. Second part is tax cuts for individuals. The benefit of tax cuts for individuals is that drives consumption. And the U.S. economy is a consumption-based economy. 70% of our economy relies on consumers going out and buying stuff. And so the tax cuts for individuals give us a great opportunity to really get some growth going. It's not going to be massive, but it'll be helping us get on the right side of that growth curve. The most significant part of the Trump plan is these tax cuts for companies. And part of that is, if it's structured correctly, it should drive investment and other economic activity. And it could be pretty significant as far as attracting capital from foreign sources. One of the things that had been happening is that companies were relocating from the U.S. elsewhere. And so if the tax code is set up in a way that drives capital in, that should create opportunity, should increase asset values, and more importantly, create opportunities for you and me. So those are the three positives. And again, it goes to the timing and the magnitude of when are those things going to come in. Now, for a lot of the people that were projecting, they were expecting that things were going to happen relatively quickly. Republican Congress, Republican president, Republican policies being put into place. What we've seen over these first 100 days is that the timing of that may take a lot longer. So there may not be an immediate impact in 2017. And the question is, when does that impact actually occur? When do we start seeing more money in our paycheck? When do we start seeing more money in our accounts that will have a real impact on the economy? And we're getting a lot of mixed signals. 3 weeks ago, as the Trump folks were putting together their plan, they were originally saying maybe we'll have tax reform by August. But a couple of weeks ago, they're basically saying August looks optimistic. And so if we don't pass anything in August, then we're not really going to get many, if any, benefits in 2017. And so it's really going to be a 2018 stimulus. And so this is going to impact some of the things that have happened in the market. So this is where we want to be attuned to the timing and magnitude of these positive factors coming into play and getting implemented and getting executed. Now the negatives, most of these have already started. And again, it goes to the timing and magnitude of these negatives. Labor pool shrinkage, up to 5% of our labor pool could be eradicated. One of the proposals for getting rid of immigrants, and we have 11 million immigrants that are, possibly being pushed out, and others that won't come just based on kind of the mood that's been set up. If we have fewer workers, then there's going to be a lot less stuff to tax, which makes it harder to lower tax rates. What we really want here is to be expanding the number of people that are paying taxes. That allows us to lower tax rates. And so this is a real challenge and a potential negative for growth. If we're getting rid of people in the labor pool, we may not be able to take advantage of a lot of the opportunities that are there. A second piece, one of the things that's been driving the global economy in the 21st century is global trade and international trade. And many of the perspectives, many of the policies that were at least presented to us were anti-global trade, anti-internationalism. And so that was going to slow down kind of the confidence that people had in participating in global trade. And that was going to reduce demand from outside the U.S. And for some of this, the toothpaste is already out of the tube. There's already been a reduction of people looking to do transactions with the U.S. And the trade policies plus global instability created by the U.S. pulling back is going to make it harder for the world economy to grow. And so this is where things like the Trans-Pacific Partnership, which wasn't just about trade, it was also about reducing China's power in the Asian and Pacific Rim. These are things that have happened where we've kind of changed the rules, changed the expectations. And as we talked about earlier, people don't like change. And when change happens, they get nervous and they start doing things that may not be in their economic best interests. And so that's why this could be a potential huge negative, and we're already starting to see some of that put into effect. The third negative is interest rates. And this is where it gets interesting, because depending on the timing and magnitude of the positives, that's going to impact the interest rates. It's potential that interest rates could go up. The Fed has already raised rates and indicated that they're going to be more aggressive raising rates. However, if things slow down, there may be more people buying into U.S. bonds because they're afraid of collapse in asset values elsewhere. And so this inflation-deflation discussion is one of the most significant opportunities and also one of the most dangerous things for us in these coming years. So it's definitely something that we need to be attuned to. So one of the things I did in looking at, I wanted to see what are other people saying. That way I could at least identify what are the obvious things out there. And through this survey, I went to different articles, different analyses. And one of the things that struck me is that most of this is pretty superficial. Most of this is pretty basic stuff and doesn't really provide us with actionable things where we can actually make money. It does give us some idea where there may be opportunities, but one of the reasons why I put this presentation together was because this was relatively useless, then we needed to do our own analysis from an active investing perspective. So through this, don't go out and do any of this stuff, but just consider it that this is where other people are looking. And this is why we want to have an independent perspective. And as an active investor, our mission is to be looking at things in a different way. And so one of the things that struck me is that looking at the conventional financial advisors, these are people that are totally bought into the passive financial investing model. And one of the things they said is you can't predict the market, so you better leave your portfolio alone. And I know this is part of the standard discussion points that the passive financial investment folks have and the financial advisors put out there. But to me, this is malpractice. This is such a dangerous thing for people to do. In a time of massive change, it's utterly irresponsible to keep doing the same thing. And if we look at the history of capitalism, capitalism has been going on for about 500 years. And for the majority of that time, people were actively involved with their investments, whether they were farmers, whether they were investing in ships and being on the board of directors, or at least electing board of directors that would look after their assets. It's really only been the last 30 years where passive financial investments have been presented as the only way that you can make money. And for me, as I've been involved with this, I learned all those lessons. And so initially, I understood the benefits of that passive financial investing model, but basically all those benefits stopped in 2001. And because in the 90s, in the 80s and 90s, we could get double-digit returns, which was a pretty significant thing, and we could count on that going up. Basically, since 2001, the financial markets have gone up about 2% per year on average, 2%. And even now, the financial advisors are saying, your expectation should be 3, 4, 5%. And this is where that earlier slide about the GDP growth is significant. Stocks go up based on growth in the economy. And so if the economy is growing 2%, you can really only expect a 3, 4, 5% return, and that's optimistic with stocks. So this is where we want to break free from the passive financial investments and start looking at double-digit returns, triple-digit returns, quadruple-digit returns. As an active investor, that's what we need to focus on. And one of the things that gets me with the financial advisors, the passive investment, it's become such a part of what's called common sense, is that people say, they compare opportunities against, well, if you had done this, then what would you have done? That was actually one of the criticisms of Trump in the election, was that, well, if he had just taken all of his money, put it into the S&P 500, he would have made more money. Somewhat ridiculous analysis, doesn't take into account actually spending money, doesn't take into account taxes and related things. But the bigger problem is that there's this perspective that you can't do it yourself. You need to turn it over to Wall Street and trust they're going to take care of you. And so one of my concerns is that the people that just created the greatest financial crisis that the world has ever seen, we're supposed to keep giving them our money. And to me, that's irresponsible. And so for you, take a look at your assets. Take a look at where your money is and say, what kind of return have I been getting? And maybe in the last 6 months, you've done okay. But over the last 3, 4 years, how much have you really made? Over the last 10 years, how much money have you really made after you paid your fees, after you paid your expenses? And I think you're going to be shocked at how little money you've made. And ask yourself this: if you're a business owner, would you ever invest in a business where you take 100% of the risk and split the profits with someone else? It makes no sense. That's what the financial advisors want you to do. So take a hard look at that and then figure out how can you start positioning your assets more effectively. Now, Online Trading Academy, one of the companies that I own the franchise for, they had done an analysis of the impact of Trump as well. And there were some good parts of this, but I also thought it was a little superficial and didn't really give us something to act on. One was they predicted there'd be continued gridlock. We've certainly seen that, and that's going to be a theme going forward. In this time of massive change, people are locking in. The second thing was an increase in volatility and the opportunity for a market pullback. We've certainly seen some increase in volatility, although not as much as some people expected, but there's been definitely some opportunities for people that are trading on a short-term basis to benefit from the policies. The market pullback has been setting up, and we're actually expecting, over the next, maybe in the next, as soon as the next week, there may be a great opportunity to enter to take advantage of that market pullback. We had a small one a few months ago, but I think the bigger one we're setting up for in the near term. Now, tax cuts, this is where what matters is what's the timing and the magnitude of it. Does it happen in 2017, Or do we have to wait to 2018 to start actually seeing that benefit in our paycheck and seeing that benefit in our accounts? And so they were expecting that there'd be some level of tax cuts, and I think this is a pretty safe bet that with a Republican Congress, with a Republican in the White House, there should be some level of tax cuts. Whether they're permanent, whether they're long-term, really doesn't have a big impact on the current state of the economy. So there may be opportunity there. I would expect that this is something that's going to happen at some point. Key is when. The interest rates and fixed income, Online Trading Academy talked about how they're expecting things to stay relatively straightforward. They weren't expecting a massive spike in interest rates, basically expecting kind of a normal range. If things did go up, they'd go up gradually. Now, on growth, they did expect that there'd be significant growth, 3 to 3.5%. I don't know if if what they're saying is totally consistent here, because, and again, it goes to what's the timing and magnitude of the infrastructure spending, tax cuts for individuals, and tax cuts for companies. There could be some great opportunities, and it's really not about the overall economy growing, it's about, is your personal economy growing? And are you taking advantage of these opportunities in your personal financial business? Now, some of the different recommendations that were out there was a number of places said, well, if there's this $1 trillion of infrastructure spending, there's going to be infrastructure companies that benefit from that. Things like cement providers, people that produce tools for construction. However, until the infrastructure spending is in place, you don't really know whether that's, who's actually going to benefit and what type of projects. So this is one, if you have some, specific knowledge of it, you may want to start identifying companies now that would benefit in the event that infrastructure spending comes into effect. However, I wouldn't put your money in today. This is where you have to figure out what does this infrastructure spending look like and when is it going to happen. Financial firms, there's an expectation that the financial firms will benefit greatly by the reduction of regulations. And so, one of the things that was taught was that they'd get rid of Dodd-Frank. Now they're talking about maybe revising it. So generally, and financial firms have seen this little bump, expecting a reduction in regulation, pretty likely to occur. Again, it depends on what's the magnitude of that and the significance. But one of the problems with this is that these are the folks that caused the last financial crisis. And so as they start going crazy again, it adds risk into the economy. Now, the regional banks, this one seems to me to be one of the better bets. And this is something that you can probably start looking to position yourself in now. These are not your Citibank, not your Wells Fargo. This is, that next tier down. And, generally they tend to be better business banks. But the idea is that they've had to incur significant costs to comply with the Sarbanes-Oxley as well as the Dodd-Frank. And so if those things get rolled back, they can reduce the money they're spending on compliance and use that and basically shift that to shareholders as profit. And that seems to me to be a pretty tight analysis. And so if that's something you're interested in, if you have knowledge of that, start identifying banks that'll be good acquisition opportunities. It's already started. There's definitely been an increase in transactions. So there may be some folks that personally that you can benefit from. Certainly defense, if the defense budget increases by 10%, there'll likely be, some direct beneficiaries. However, you need to understand, where's that money going to be spent? Is it going to be spent on equipment manufacturers, weapons manufacturers? Is it going to be spent on people? And that's going to determine the impact and the timing and how big that is. And again, in this area, in the DC, Baltimore area, your next door neighbor may have inside information. You may have information that you can use to benefit in this event. At the same time, we'll talk a little bit later, there's also some concerns with that if you pick the wrong company. One of the things that people said was, with this assault on globalization and international trade, if you invest in U.S. companies that are less reliant on international trade, they'll probably do extremely well. The problem with this is there's very few U.S. companies that are less reliant on international trade. It doesn't mean there's none, but you have to work kind of hard to find them. And so again, this is where you've got to do some analysis and see of the 4,000 firms that are publicly traded in the U.S., how many of them have less exposure internationally? These days, very few companies are strictly produce in the U.S. and sell in the U.S., but there are some. So those are ones that you can identify and see if there's an opportunity there for you. Technology infrastructure, this seems to me to be a pretty fair bet, as this was happening over the last several years anyway. And this goes to some of the trends that Friedman talks about in the Thank You for Being Late book. Big data, cybersecurity, particularly in this area. We have probably the biggest concentration of cybersecurity firms in the world. And so this is where, again, take advantage of your personal network. Talk to some people, that your neighbor, your friends that are involved with this. My bet is there's going to be great opportunities in cybersecurity, right? I mean, every big company has been breached, right? Target, Yahoo, Wells Fargo, there's a whole bunch of them that have been breached. And so there's going to be a lot of money available towards cybersecurity. And we're right here in the hotbed for the folks that are here in DC and Baltimore. So take advantage of that and start looking for these opportunities, whether you're actually doing it yourself or where you're investing in a company that's going to benefit from this. This is definitely one of the macro trends and the great opportunities over the next several years. One of the areas that was identified was healthcare companies. And this was expected that somehow by repealing the Affordable Care Act, Obamacare, there would be some great benefit to these companies. I think the healthcare system is so convoluted, there's going to be winners and losers there. And insurance companies may lose, there may be providers that win. This is where, if you have specialized knowledge, there may be an opportunity. But my perspective is, because it's so highly regulated and we don't really know what's going to happen from one day to the next, this is probably an area to steer clear of. Another recommendation that was out there was pharmaceutical companies. And the expectation was that they're going to, with reduced regulation, they'd be able to get FDA approval much faster. And one of the issues is that the companies that are actually designing new drugs and building new drugs aren't the big pharmaceutical companies. The big pharmaceutical companies have basically been tapped out in their R&D and have nothing significant being developed. However, there are biotech companies that are likely, they have the opportunity to develop something and then get acquired. So, and particularly in Maryland, if you go up the 270 corridor, there's a number of these biotech companies out of Johns Hopkins and others. This is where, again, use your local connections, use your network to find some of these companies. And I think there's going to be some great opportunities for the biotech companies that could develop things quicker and then also get acquired going forward, or even just to develop into a more significant company. So again, not pharmaceutical generally, but look at those that are developing new drugs. Energy companies, part of this recommendation was the expectation of the removal of restrictions on oil and gas drilling. At the same time, we'll talk about how those companies are generally benefit as prices go up in oil and gas, and with the increase in drilling, the likelihood of oil price going up significantly is probably pretty low. So this is one where people are recommending it. I don't see how that's going to be particularly beneficial, maybe to a couple of individual companies, but overall as an industry, this is one I definitely would steer clear of. One of the recommendations was that with instability, that gold and other precious metals would go up. And generally, when gold goes up, the mining companies go up. this is one of those throwaway recommendations. The financial advisors don't care. They have no accountability to you. People hold gold. They have money in mining companies. However, I think we'll see what the markets had to say about this and whether this is really a valid thing for you to be focused on. One recommendation was personal security. Now, it wasn't clear to me why we're going to be in a much less safe world, but the expectation, I guess, was that as we get more into this you're on your own world and you have to care for yourself, that you can't rely on the police anymore. You need to start providing your own security. Maybe overstated, maybe not. We'll see how things develop. But again, I don't know whether there's a significant opportunity for you as an active investor in this. One of the things we know, when tax cuts happen and people have more money in their checking account, in their hands, they go out and spend it on stuff. And so consumer luxury goods generally go up. As economic growth increases, things, whether it's clothing or travel, that's where people spend their money, and those brands tend to do extremely well. And I don't even know what the good brands are anymore, but in the old days, it would be things like Gucci and stuff like that. Whatever they are, if you have insight into what the luxury brands are, then there's probably going to be an opportunity for you once these tax cuts get put into effect. Now, the other side is that based on the policies, there's going to be areas to avoid. And the problem with these is that they're very, very big, and more than likely, you're probably exposed to them if you're involved with passive financial investments. So one of the areas to avoid are multinational companies. And multinational companies were basically the whole global economic system was set up to benefit these multinational companies by encouraging international trade. And so if you have money in the S&P 500, almost every single S&P 500 company is a multinational corporation that will be negatively impacted by these policies. There's some potential that tax cuts will be positive, but if there's an assault on international trade, and the indications are that some of these things have already started to happen, that you don't want to have your money in a multinational company. In fact, it would be absolutely insane to put your money in a company when you know that they're going to be under assault. Other companies that are going to be impacted, U.S. import companies, because if they put in this border adjustment tax or tariffs or whatever it is, whatever they want to call it, basically they're going to make it so it's harder, it's less attractive for people to use imported goods. And if that happens, then a lot of the profit goes out of the U.S. import companies. The other side is that if we're doing it to other countries, then these other countries are going to be less likely to buy stuff from us. And so U.S. export companies are going to be negatively impacted because the rest of the market, they're not waiting for us to act. They're going to start making it harder for us to sell stuff abroad. And so that's a huge negative of the potential policies that have been presented. And so the problem with this, if you look at multinational companies, if you look at U.S. import companies, if you look at U.S. export companies, what's left? Not much. I mean, and you may be involved with some companies, maybe some service-based companies, but basically what this does is it gets rid of the vast majority of investable companies are going to be negatively impacted by these policies. And again, this is why we don't want to be passively investing during this time. We need to be looking for opportunities for our money to grow double, triple, quadruple digit returns in these areas that's very unlikely to happen. Another area that people have not focused on is that international trade, one of the primary beneficiaries are U.S. farmers. We ship corn and wheat and all sorts of other stuff abroad, and that's what most of these trade deals deal with. Trans-Pacific Partnership, NAFTA, whatever deal, usually it's the farmers that are benefiting. And this is one of the things that strikes me with this anti-free trade approach is that farmers are going to be under assault. And there's already been a tax on the budget for the Department of Agriculture, Department of the Interior. this is a huge impact on, the family farms, and also too, the folks that do community-based farming, like a CSA, they're going to be impacted, as if international trade slows, there's less opportunity, the price of things will go up. As supply shrinks, there's going to be, it's going to be prices are going to go up, and it's going to negatively impact consumers and certainly negatively impact farmers. Government contractors in this area, we talked a little bit about how it may be beneficial to find defense companies. However, every defense company is a government contractor, and government contractors are under assault. And we know in this area, in the DC, Baltimore area, companies that do government contracting are basically circling the wagons. They're reducing their overhead, they're getting rid of their commercial space. They're trying to figure out, how do I start shedding cost in the event that contracts that I'm involved with get pushed away. And no one's saying this in public, but the reality is the government contractors are on a very thin ice right now. And they may have, there's going to be some that are going to go under as these contracts get removed. We may start seeing that this summer. It may be delayed to 2018, but if you're a government contractor, what you need to be doing during this time is to take the cash flow that you've got and start investing in other business opportunities, so that if this government contracting business goes away, that you've already seeded your future with 2, 3, 4 opportunities that'll allow you to continue to generate cash flow. And so this is part of having the active investor mindset and making sure that you're taking advantage of what you have now and not just assuming it's going to go on forever. Because in this environment of massive change, assuming that things are going to stay the same is the most risky thing that you can do. Other companies that are in a dangerous spot are technology companies. And one of the things that technology companies need are highly qualified, bright people. With the immigration policies, making it harder for people to get the H-1 visas, the talented people will just go somewhere else. And so that's definitely a huge impact. A brain drain on the U.S. economy is huge, and it's going to have a major impact on the technology companies here. One of the things, if you go to Yahoo Finance at the beginning of the year, January, February, there were ads to invest in the next great marijuana company. This is going to be the next whatever. And think about it. You have a government that is, you have this federal-state tension. And, we have the Attorney General who has at least stated that they're going to start enforcing the federal law over the state law. To me, having money in these marijuana companies that are put out there as, this great opportunity is incredibly risky. It could be shut down in a day. And so I think this is an area to definitely steer clear of. Another thing is utilities. Utilities tend to do well in stable environments. And what's happened is that they basically give you a couple of % return. And in this low return environment we've been in, they've done okay. However, as interest rates go up, that negatively impacts them, and they're basically right at the center of the transition in the energy business. As there's more renewables, wind, solar, water, stuff like that, changes the whole model for these utilities. And so they've absorbed a lot of costs. They may not be able to generate the income they need to support that infrastructure. And so it's one of the tensions of the renewables industry. And so utilities are definitely something that you're going to want to steer clear of if that's something that you have some established investments in. Areas that could go either way. Interest rates could go up, they could go down. We've already seen them go up, we've already seen them go down. And so there may be a great opportunity in inverse bond funds. So meaning that if interest rates go up, there may be a great opportunity to make money. However, if there's a lot of uncertainty, if the international system starts breaking down, then We want to be the other side and actually own bonds as opposed to being inverse to bonds. And so this is something that could provide you with a great return, could provide with great risk to the downside, but I think it's definitely something worth considering. And this is where we have to focus on what particular policies are being put into effect and the timing and magnitude of those policies. Another area is the US dollar. For those of us in the US, generally a strong dollar is good for us as consumers. However, if our policy is to encourage the US to do more trade, there's kind of a tension to try to lower the value of the dollar. And so if the whole policy is focused on US companies exporting abroad, there's also a government interest in talking down the dollar. And we've seen that happen over the last 3 months as well. And so this is an area that could go either way, and again goes to the specific policies that get put into effect. Commercial real estate. As interest rates go up, commercial real estate tends to go down. However, if things stay the same, there may be some great opportunities there, but we're also seeing a major shift in people's buying habits. So shopping malls are basically becoming like vast wastelands. They're almost, we're going to start seeing tumbleweeds go through, like the ghost towns out west. And, we're starting to see it around here, is that in commercial spaces, when a space comes open, they're not filling up as quickly. And part of it is there's less demand for physical commercial space. This is definitely an area, this is one of the canary in the coal mines for us as active investors. When the economy starts slowing down, people have less money to put in, then those commercial spaces, all of a sudden you start seeing more vacant places. Or even if someone is moving in, they don't move in as fast. And so this again goes to the timing and magnitude of the infrastructure spending and the tax cuts. If these aren't put into effect, we're going to start seeing more commercial space available, and that's going to get us into a kind of a recessionary cycle. At the same time, if the tax cuts come in and people's optimism grows and their hope and their confidence grows, we may all of a sudden see all those spaces taken up. So this could go either way. There's an opportunity for you there. Finance companies. There's a lot of different ways people get financing. Banks, in theory, banks lend money to businesses so they can establish new opportunities, expand their business. The reality is banks stopped lending for a significant period of time. They've started to lend, but in the meantime, there's been a lot of other companies that have developed that provide funding. And they're very sensitive to interest rates. If interest rates go down, those companies can do extremely well. If interest rates go spiking up, they could be extremely negatively impacted. So this is something that, understanding the interest rates, understanding the value of the dollar creates great opportunities and also great risk for us as active investors. Now, Trump's election on the markets, in my view, really has the potential to be earth-shattering. Now, over the last 3 months, what we've seen is that the other side is that it may have a very negligible impact if he can't actually get anything done. And so even everything that we've talked about here today, if nothing gets done and it's more of the same, then we revert back to that low growth environment, a no hope environment, or no confidence environment, which is very difficult for you to develop new opportunities. However, if we're in a no growth, a no hope, and a no confidence environment, it means that there's a much more of an imperative as an active investor to be finding these opportunities and getting yourself out of the low return, high risk opportunities so you can at least be looking for some high return opportunities. And so I think there's been a major change, and this is where you've got to break free from everything you've been doing up to this point and start looking at how can I start using my assets more effectively going forward. Now, this is a chart, and it basically ranges from about August into the beginning of April. And November is right there in the middle, and you can see there's a huge spike. This is the US stock market. And basically, at the time before the election, you could see it was trending down. And heading into the election, all of a sudden, once Trump was elected, things took off. And the reason why things have taken off is the anticipation of the infrastructure spending, anticipation of tax cuts for individuals, anticipation of tax cuts for companies. It happened with the S&P 500, happened with the NASDAQ, with the Dow. Just this week, the NASDAQ hit a new high. So the stock market has basically moved up about 10 to 15% since Trump's election. However, in the last several months, it's basically waiting to see what's going to happen. And if you've already benefited from this, it's probably not a bad idea to take some of your money off the table here and start looking for active investing opportunities somewhere else. The U.S. stock market, the ups and downs have provided you with great opportunities. And at the same time, what you want to do is be able to do better than what this is providing for you. These charts are the same time frame, but looking at bonds. And this is the value of bonds. As bonds go down in value, interest rates go up. So what this has told us, basically since the election, leading into the election, interest rates were kind of inching up. Once Trump was elected, interest rates went up. And basically what we've been doing is been in this holding pattern, waiting to see what policies are going to be put into effect. What kind of stimulus is going to be put into effect, what kind of infrastructure, and so deficit spending will impact this. There's definitely a lot going on here for you to be able to take advantage of the opportunity to see what's happening. The bond market is telling us they're waiting to see. Depending on what happens, they could go back up, they could go rocketing down. So there's definitely some unease, but basically we're just in a holding pattern waiting to see what's actually going to happen. Now, here's a chart of the US dollar, as well as the US dollar versus the Japanese yen. And as you can see from the election, the dollar basically got stronger. And a lot of that is based on the policies that are being presented by Trump. The making it harder for others to take advantage. We're basically getting back to like a mercantilist policy, like from Adam Smith era, where if we manufacture more stuff here and focus on our own economy and then export stuff out, we should be developing a stronger dollar. The other side of that is that if the government wants to encourage exports, there's an interest in the government to try to talk down and hold down the value of the dollar. So this is one of the tensions that we're going to see depending on the particular policies. And so again, the dollar has shot up and is basically in a holding pattern to figure out what's going to happen next. If we look at currencies, and currencies are the lifeblood of the global system of international trade, because every time you buy something in China, money flows from the purchasing country. As money moves around, that impacts the supply and the demand of the dollar. One of the things from the policies that are being pursued, the administration has been anti-Europe, and it's encouraging, it's almost encouraging Europe to be under threat, and providing basically the assault on NATO, the assault on the established governments. The euro is in a very precarious spot. And certainly Greece, caused a lot of headaches for the euro, but Greece is just a small piece of the European Union. Italy, Spain, much more significant. France, if France decides to break next week, the euro is going to be under assault and will likely continue to get much weaker. What's happened in the meantime is that the euro has actually gotten stronger, and so there's going to be an opportunity, depending on how much instability there is, that the euro could go down significantly. And you can see from the chart, that's what the markets were expecting. They basically pushed it way down. And again, the euro is in a holding pattern. It's actually on the high side of its holding pattern, but I think there's going to be a great opportunity to make money on the downside of the euro for a long-term opportunity as well as for short-term. British pound, same thing. With the Brexit coming, there's a lot of uncertainty. It's not really clear what Britain is going to be able to do over the next year and a half as they break free from the euro, from the European Union. And so this is an area that they just called an election next month or in June or something like that. So that the results of that election are going to impact the value of the British pound. Now, the interesting chart to me is the Australian dollar, US dollar in the upper right-hand corner. The Australian dollar used to be the #1 predictor of what was going to happen in the US market, the S&P 500, because basically Australia benefits from globalization. Australia benefits from growth in China. Australia benefits from growth in India. But really for China, if China wants to grow, the stuff they need to grow, they can get from Australia. And you can see initially there was a concern and the Australian dollar went down because the expectation was that China was going to be under assault by the Trump administration. However, in the last several months, the Trump administration has taken a very different approach to China. And they basically, by pulling out of the Trans-Pacific Partnership, we basically turned Asia over to China. And so the Trump administration has been very pro-China, whether they meant to or not. But they basically did exactly what China would have wanted us to do and they didn't even need to lift a finger. Because the Trans-Pacific Partnership was set up to basically undercut China. It was so Asian countries would deal with North America, would deal with Mexico, Canada, the US, and so there'd be kind of a tension against China, and it would give us some negotiating leverage. By pulling out of that, we basically turned over Asia to China, and each of the countries that were part of the Trans-Pacific Partnership from Asia have all gotten a similar deal with China in the meantime. So that's why you see Australia benefiting. The other side, if you look at the talk in Europe, we've been very pro-Russia, so that's why the euro has been under assault. And so depending on how we continue the pro-China, pro-Russia policies, then there could be a great opportunity in shorting the euro versus the Australian dollar. And this could be a generational wealth opportunity for you. So that's something that, again, the pieces haven't come together yet, but there's great potential for those to understand kind of the dynamics of the Forex market. Now, the futures market is where we start seeing where real money is moving. And what I have here is the big chart is copper. And copper is one of the most significant things to track when you look at global growth. Because if you're going to grow, you're going to build buildings, you're going to buy computers, all those things require wiring. Wiring requires copper. And so copper had basically been in the doldrums for several years. Basically since 2013, it really hadn't done much of anything. It had gone down significantly from where it was as global growth was happening, largely due to the slowdown in China and India. Well, you can see at the election, all of a sudden, copper went way up because the expectation of if there are pro-growth policies in place, people are going to start building stuff again, and copper is basically the canary in the coal mine for global growth. Global growth is good for us, and so this gives us a nice indication. People are expecting significant growth. If you look at gold, remember, people were saying, oh, with instability, with uncertainty, put your money in gold. Well, the reality is that would have been an awful thing for you to do. And you can see, gold cycled down and it came up a little bit, but recognize, gold from a seasonal perspective generally goes up from October into February, largely due to people buying gifts for Christmas, buying gifts for Chinese New Year, stuff like that. You can see it was already trending down even in that seasonal support. Once the seasonal support ended, things basically went significantly down. So not a place that you want to have your money, not a place where you want to be investing, not a place for serious folks. Oil, another thing. When I first did this presentation, oil was up at $55. And the assumption is if we increase drilling and we increase transportation through pipelines, if we open up more areas for drilling, that creates more supply. What happens when supply grows? Price goes down. You know, for the folks that were here at our first presentation, they were able to benefit from this significant drop in the price of oil. Now, the price of oil has actually gone back up again. It's going to give us another opportunity to benefit from the downside as more oil is pumped. We expect that the price of oil is going to go from 55 down to 45, 35, 25. So this is one of your generational opportunities to make significant wealth if you understand how to take advantage of these opportunities. Now, as we get to international trade, one of the big things traded is food. And so the big chart looks at corn, and you can see once Trump was elected, the price of corn started to go up. The price of food has major impact on stability or instability in less established countries. And so, the Arab Spring back in 2011 was largely driven by the cost of wheat and the cost of commodities. And basically, people couldn't afford to eat. And when people can't afford to eat, they go out and do stuff. And they rebel against their governments. And instability is a negative for global growth. And so, also, as a consumer-based economy, if our food, if you have to start spending more money for your weekly grocery bill, then that's going to slow down other aspects of the economy. Because people are going to spend money on food, but if they have to spend too much of their money, then all of a sudden the economy slows. And so this is something we definitely want to keep our eye on, is to make sure that food prices aren't spiking, because that's going to erase a lot of the benefits of any consumer benefit of getting tax cuts. You can see already, the price of cattle has gone up. And so, people are expecting, you're paying more for beef, you're paying more to eat well, and so you're going to have to start shifting your dollars. Now, one of the interesting things is that coffee collapsed after the election. And some of that may have just been through, crop industry. I just think it's funny that all of a sudden they thought that people were going to be drinking fewer lattes or something like that with Trump in office. But, coffee, the price there has dropped significantly. That's good for you as a consumer, not good if that's your, if you're a farmer. Then I get into individual companies, and the big chart is Tesla. And it was interesting, they're leading into the election, and even after the election, the expectation was that Tesla would not do well, because basically they were in a favored status with the Obama administration and presumably under the Clinton administration. However, when Musk all of a sudden read the tea leaves and he joined Trump and basically started to support Trump in December, look what happened to the stock price. It went up pretty significantly, 20, 30%, shot up. And then started to fall out of favor, things dropped down, then he got back in favor and things went up. This is one of the dangers of investing in individual companies, because in this world where a tweet can decrease your market value by 10 or 15%, it's an incredibly risky opportunity. You can see in Nordstrom, remember Nordstrom was actually doing quite well heading into their busy season. They were doing well in November, December, and then as Ivanka's stuff started to not sell, then all of a sudden they became under assault and their stock price plummeted. And so this is one of the dangers of investing in individual companies in this current market environment, is that with one statement or one flip-flop or one change in policy can drastically impact your wealth. And it's just not worth taking the risk to have your money exposed to individual companies that you are not actively involved with. And Twitter, this is the Twitter presidency. I have the chart of Twitter up. You'd think that they would have done well. For them, not so well. And part of it is, Twitter still doesn't have a significant business model that'll drive growth going forward. But I caution you, to use the 1980s, 1990s, picking stocks were a great way to make money. In this environment, incredibly ineffective use of your capital, high risk, low return approach. In a time of massive change, taking high risk, low return approaches, not the smartest thing for you to do. So what do we do next? Stock markets. Basically, this is where you need to be totally attuned to the news. If you have money in the stock market, you've got to be looking at what's the likelihood of tax cuts coming, what's the likelihood of infrastructure spending coming, does the government get shut down in the next few weeks? We don't know. That's going to be a negative impact in that event. So I'm thinking that there's going to be an opportunity in the near term to take advantage of a market pullback. However, at the other side, there's a lot of optimism in the market, and so this is where you have to balance it and make sure that you're not missing out on opportunities. And so, with the markets way up, what we need to look at are some signs of weakness and some signs of people pulling their money out. It's already started, is that individuals have pulled their money out. One of the things we want to see is when people start getting back in, that's going to be our opportunity to start shorting the market. The US dollar, the mercantile approach of having a strong dollar is, that's basically was what the stated policy of the Trump administration was going to be. However, the other side, if we want to be a strong export nation, then we need to talk our dollar down. And that's what's been happening over the last 10 years, is this battle to the bottom of the value of the different currencies. And so this is something we definitely need to be attuned to and take advantage of, the global flows and the opportunities related to that. With the bond markets, interest rates are going to go up with tax cuts and infrastructure spending. There's going to be more going on. People are going to be willing to accept more. They're going to need to, as other opportunities open up, bonds are going to need to have increased interest rates to be more attractive. However, if the tax cuts don't come, or if the infrastructure spending doesn't come in a significant way, we expect interest rates to kind of grind down and basically be in a low growth environment. And so these are things that we need to be really focused on. This is where you're going to get some of your best opportunities to be able to identify where is the market headed based on what the market's doing. Commodities. We want to be watching the supply and demand. If we're producing a whole bunch of oil, prices are going down. We want to keep our eye on copper. We want to see, is there still demand out there, and is the global economy moving forward? And by looking at these things, that's going to give you an edge over everybody else and identify some of the active investor opportunities that make sense for you to pursue. Now, if we look at the areas of policy emphasis for Trump, there's a number of pro-growth policies. There's also a number of anti-growth policies. And so the tax cut for individuals, definitely pro-growth for a consumer-based economy. Tax cut for companies, definitely pro-growth. And particularly, one of the most significant things they're talking about here is it's not just for C corporations. In the past, whenever they've talked about corporate tax reform, it's been for C corporations, not pass-through entities. And 90% of companies are pass-through entities. So the individual tax rates were more significant. However, one of the things that's being talked about is that applying the reduced corporate rate to pass-through entities. This would have an incredibly significant impact on the bottom line of an active investor for all of your pass-through companies. And so this is definitely an area where there'd be more money available for you to do other stuff. Infrastructure spending, pro-growth, increasing oil production means that people are actually using it, so that's a pro-growth piece. Regulation reduction, definitely opportunities for improved growth with less regulation. And now, also recognize that a number of Trump's policies are anti-growth. And again, this goes to the balance of the timing and the magnitude of each of these. Being anti-free trade in a global economy that's based on free trade is going to slow things down. We've already started seeing that. The first quarter was a significant slowdown. I think, the data that came out this morning was something like 0.7% growth, not very much. And part of that is, people are kind of circling the wagons and wondering what's going to happen next. Without certainty, then people start wondering, which side of the bread are they going to put their butter on? And so anti-free trade, anti-farmers, that's a definite anti-growth policy, particularly for certain regions in the U.S. Anti-immigration means there's fewer people to do stuff, and particularly for technology companies, but also for the daily tasks that you have. People that are mowing your lawn, people that are taking care of your kids. If there's fewer people available to do that, either the cost of that's going up, or there's just going to be no service providers available. And so there's going to be some restrictions. And one of the problems with that is that it drives up the price of labor. And so for some of the U.S. folks, the wages are going to go up. For a business owner, wages going up definitely is going to have a negative impact on your bottom line. The anti-government and shrinking the government, while generally there's some benefit to that, at the same time, folks with the government get money and they spend it. And so if we're pulling money out of the economy, the consumer economy is going to slow down, particularly in the DC, Baltimore area. As we have more people that are pulling themselves out of government employment, pulling themselves out of government contractor employment, there's going to be less economic activity associated with that. The move to valuing security over freedom. When people are afraid, they start valuing security. And they're talking about terrorism, they're talking about this. When people are afraid, they tend to do less economic activity and curl up in a ball and remove themselves from the global economy. And so we haven't really had a massive move in that direction, but there's a potential that people's mindset impacts our growth. And we've had that over the last 15 years, where we've had periods where people were so afraid they weren't transacting things economically. And so that's a negative for you. Now, the regulation reduction cuts both ways. In some areas, reducing regulation can free up some opportunities, free up some capital. At the same time, not all regulation is bad for economics. When there's a market failure, regulation can protect us. I know for me, when I travel somewhere else, if I have a bowl of cereal in the US, I pour it out and I eat it. If I have a bowl of cereal anywhere else, I'm looking around to see, am I going to get a nail? Am I going to get a bug? What am I going to get? So there's an aspect of regulation that provides people with more confidence in economic transactions. And so if we go too far on the regulation reduction, then that can also serve as a negative for growth. The financial services folks, perfect example. We have this Consumer Financial Protection Board, and they've identified, companies like Wells Fargo that were basically stealing from their customers, and billions of dollars. That's a negative on the economy. If all of a sudden we remove that regulation, then the companies are going back to stealing from their customers. And if people are stealing from their customers, then that's definitely a negative for growth. And people lose confidence in institutions, and it basically degrades the opportunity for all of us. So it's something where there's definitely some pro-growth, anti-growth. These are things that you want to be attuned to and see how they're being impacted. Now, for me, I identified a number of scenarios: the optimistic scenario, the half-full scenario, the half-empty scenario, and what I was calling the realistic scenario. And I think it's clear that the optimistic scenario is out the window. Now, when I first did this, I was thinking, the half-full scenario, some pro-growth, some anti-growth policies implemented in 2017, and they'd kind of balance out. That's where I started with this, and I was kind of expecting that's where we were going. However, I think we're definitely more towards the half-empty scenario, and unfortunately, we even have to start considering this realistic scenario, although I don't think that's going to happen. some pro-growth and anti-growth policies implemented in 2017 in an unbalanced fashion. I think that's what we're seeing. We've seen a number of the anti-growth policies implemented. However, some of the anti-growth policies have been reduced or been de-emphasized. We haven't seen the pro-growth stuff come in. However, I do believe we're going to start seeing some of it probably in 2017, probably not in the next week, but maybe by the summer. We'll see. However, I think the gridlock scenario comes into play now, because what we've seen is over these first 100 days, the Trump administration has been largely ineffective on putting things into action. They've been good at defining the discussion. They've been good at setting the terms of what they want to accomplish. However, the actual work of the politics and actually getting stuff done and executing has really been a weak point. And so if that scenario happens, that's a huge negative, because all of the positive that we're expecting is really in anticipation of tax cuts, in anticipation of infrastructure spending. If none of that happens, there's going to be a huge pullback and a huge impact on our hope and confidence, and that's what that equals a recession. And so we definitely don't want that to happen. So the half-empty scenario is where I think we're heading. However, I think the realistic scenario is actually in play right now. Some of the icebergs out there, things that we need to be concerned with, that we may be somewhat aware of, but they're sitting under the surface and could have a major, major impact on any plan that's going on out there. Doesn't matter who's in office, doesn't matter what's going on. These icebergs are incredibly significant and could derail any plan that someone has. One is instability. If the global institutions start breaking down, if we start seeing assaults on North Korea and Syria and stuff like that, that could have some pretty significant impact. If Russia starts invading people again, we haven't seen that. We've seen some symptoms where there's a possibility that puts the market on edge. However, I'm talking about significant instability. That could grow, and we have no control over that. That could happen relatively quickly and definitely to erase any positive impact that's out there. Terrorism. Terrorism gets people to value security over freedom, gets people to curl up in a ball, and stops economic activity. There's been small acts, but nothing particularly significant. However, we're one day away from the potential for a massive terrorist attack that would, again, change the course of history. If you think back to September 11th, however many people were involved with that, what was it, 19 people, 20 people? Those 20 people had, basically have impacted the course of human history over the last 16 years and probably going forward. And so there's always the potential for something significant like that. And so as an investor, what we need to do is we can't be living in fear of this happening, but we need to position ourselves to make more money and get more income in the event that these icebergs come to play. Now, the U.S. has about $19 trillion of debt, and that's largely denominated in bonds. A significant part of that debt is actually held by foreign countries. Last year, the largest holder of U.S. government debt was China. The number 2 holder of U.S. government debt was Japan. And there's a bunch of other companies and countries that have significant pieces. China had held over $1 trillion of that 19 trillion. So, 6 to 7% of the outstanding debt China held. And so this is where the policies, Trump is certainly not as aggressive towards China as he had projected that he would be. And one of my concerns was, as we assaulted China, China had the ability to just sell off a significant part of its bonds. As bonds get sold off, interest rates go rocketing up out of control. And so I think one of the things that we've seen with that tempering of the relationship with China and not being as combative with them is largely to address the potential of a China bond sell-off and really others selling off the U.S. And this is where, you got to remember the whole global system was set up by the U.S. to make it so that everybody could benefit, and we were one of the primary beneficiaries. If the U.S. pulls itself back, if it removes itself from that system, then what we have is potential chaos and anarchy. And there's also less incentive for China and Japan to care about protecting the U.S. economy. One of the things that saved the global economy was in 2008, 2009, basically everyone got together and agreed to support the U.S. because if they could support the U.S. economy, then we'd still be able to buy stuff from China and Japan. So that was the deal, and that's why China and Japan were the top bondholders. Well, based on what was going on last year, when Trump was elected, China continued to get rid of U.S. bonds. China is actually no longer the #1 holder of U.S. bonds. Now it's Japan. So China has already started to divest itself from the U.S. And the severity and the velocity of that is impacted by the policies that we pursue. And so I think what you've seen over the last several months is that Trump has been less aggressive, which makes this risk less significant. However, it is sitting there, and it is something that we need to be aware of, as basically the fate of our economy is in the hands of other folks. And so we need to be somewhat cooperative with them and keep them on board with us. Leading into office and for the first month or so, the whole assault on NATO, the whole being pro-Russia, was basically allowing former allies to say, well, if you're not going to protect us, we're going to go our own way. And we get a lot of benefits from folks that were our allies, and so that's a huge impact. If all of a sudden we're not going to stand up and protect Europe, then that creates a massive amount of instability. Again, in the last month, we've started to see a shift back, that NATO is now okay, we're less pro-Russian than we have been, but at the same time, this is something that as the global system has relied on the relationships, basically if we start assaulting those relationships, we're going to be in a time of massive change, and we've got to be able to read the tea leaves and see where that's going. Financialization. What's happened over the last 30 years as passive financial investments have become the primary way that people use their capital is that financial transactions have made up a much larger percentage of the U.S. economy. It used to be financial transactions made up about 6% of the economy. Now it's closer to 20% of the economy. And that's basically just someone moving paper around and charging you fees for that privilege. And so the financialization is really an unhealthy anti-growth. It's kind of an infection that we have in our economy. And so as this is sitting there, this is where the regulation comes in. If we remove the regulation that we have, basically what we did was we had an industry that took enormous risks and we bailed out. And in exchange for us bailing them out to the tune of trillions of dollars, then they had to accept these regulations. If we remove those regulations, they're going to put us at risk for even more trillions. And so there's a real danger of the significance of the financial industry in our economy right now. The pension explosion, it's been going on, it's continuing to go on. There are localities, there are states, there's federal government that has pension obligations. They've promised people money, and people expect to be paid that money. And what people are realizing is that in this low or no growth return environment we're in, they're not going to have enough assets left to actually make the payments. So in the city of Dallas, basically, Dallas is one of the healthiest cities in the country, except for their pension, and people are rushing there to pull their money out because they realize it's going to be bankrupt in a short amount of time. And Dallas is just one. There's hundreds, thousands of other places that are going through that. One of our offices for the Online Trading Academy is in a building that used to be owned by CalPERS. CalPERS is the California pension that is the largest public pension. And last year, they actually lost money. And because they lost money, they were in a cash crunch, so they had to sell our building to some other folks just to be able to pay their basic obligations out there. We're starting to see the cracks in the system. If there's a huge pension impact, either there's going to be people that were expecting money that aren't getting it, or somehow they're going to ask the government to bail them out. In either case, that's a bad scenario. In Greece right now, they basically, people have been getting pensions since they were whatever age, 55, and part of their austerity is that now those pensions get reduced every month, and people don't even know what they can expect in their monthly check. And there's people that own cars that can't afford gasoline, and so that's where this pension explosion has a potential amazing impact on certain regions in the U.S., but certainly on individuals as well. Baby boomers have been, they've been a significant population move, and they've helped feed the growth of the U.S. economy from the 50s even into the present day. But as more and more baby boomers retire, and as more and more baby boomers stop being productive, and continue to make demands like getting Social Security and Medicare, they're basically just a huge cost and a huge drag on the U.S. economy. And so this is where there's going to be some significant choices made policy-wise that are going to impact them. And some people may not like the answer. Another thing, there's a potential if the global economy loses faith in the U.S. We've basically been in a privileged position as an economy, as the architect of the global economic system, as the architect of this world based on international trade. If we significantly pull back from that, if we basically go into an isolationist mode, then the people, the low interest rates we've been able to enjoy are going to go out the window. And again, this goes to timing and magnitude. I don't believe it's going to happen, but it's certainly within the potential, if we significantly pull back from the world, that the world may pull back from us. And that's going to could has the potential to be extremely negative for us no matter what happens. So these icebergs are sitting out there. It doesn't mean we're going to hit any of them, but just recognize that these icebergs are there and could throw a wrench in any plan that anybody puts out there. And so we want to be attuned to the potential downside of everything we're doing. Now, internationally, as the U.S. removes itself from the global economy, as the U.S. is no longer preeminent and takes itself out, that's a huge negative for Europe. There's probably going to be great opportunities within the U.S. because the U.S. is still a strong economy, and we're going to be able to, there'll definitely be some positives for the U.S. economy. But for Europe, the U.S. pulling out is going to be a huge negative for them. So we definitely don't want to have any exposure in Europe. The Americas generally have benefited from the U.S. helping provide them with some stability. With the U.S. pulling back, that may or may not impact particular countries in a negative way. So there may be opportunities in Central and South America. There may be more instability there. So higher risk opportunities. Africa, I think, provides some great opportunities. Again, as Russia, China, and US and the relationship of them globally changes, there's going to be major impact on Africa. Up till this point, over the last several years, Africa has been one of the highest growth areas. Between now and 2050, most of the population growth in the world is going to happen in Africa. And we're going to go from having, of the top 10 population countries in the world, we're going to go from one African country to 5 or 6 African countries. So there's going to be a swing in population. There's also going to be a swing in opportunities. As there are more people, there's going to be more economic opportunity in Africa. So I think that's one of the areas you want to look at. With the melting of the Arctic ice cap, all of a sudden we're having sea lanes that never existed before. And there's security issues related to that. There's also commercial trading opportunities related to being able to send a ship for a longer period of time because it's not an ice-packed place anymore. And so there's going to be economic activity in places that have never had economic activity. So there'll be some boom towns, there'll be some boom opportunities in the Arctic. Just make sure you bring a sweater, right? There's going to be opportunities for shipping, there's going to be opportunities for whole cities. And so that may be something you want to attune to. If we start doing more drilling in the Arctic Ocean, there's going to be opportunities up there. And so that's an area that you want to get yourself focused on. With Asia, by pulling out of the Trans-Pacific Partnership, we basically have turned that over to China, basically gave them Asia. And if we're giving that, from the US perspective, there's going to be less opportunities for US business people. One of my friends had been working on a deal in Asia for a significant amount of time. And as they were getting ready to close, because of the policies and kind of just the positioning, the folks decided instead of doing it with a US company, they were going to do it with a Chinese company. And so those things have already started to happen. Australia, I think they're well positioned to take advantage of China's preeminence in the Pacific Rim and in Asia. And so there'll be likely good opportunities in Australia for folks as we go forward. Middle East, and basically you've seen it happen already. As we get more insular, as we pull back, we're basically getting, we're basically removing ourselves from that. And that, that could just be a bunch of people fighting each other, right? If we're pumping more oil in the US, then we don't need the Middle Eastern oil. And if we're energy independent, then the Middle East is going to be left on its own. And certainly not a place that you want to have your exposure to. Impact on multinational companies. Vertically based US operations will thrive. Basically, those that use stuff that is produced in the US, manufactured in the US, and sold in the US. That's going to be those companies that are well positioned to take advantage of the Trump administration policies. However, multinational corporations that export and import will probably need to drastically change their business model to thrive in the current system. Passive financial investments. Generally, if you're invested in a stock fund, you're investing in multinational companies. Multinational companies are under assault. You probably need to start shifting your focus from that. Potential huge negative for bonds if interest rates go up. And as interest rates go up, that's a huge negative for real estate investment trusts. So these are the three primary passive investment vehicles. And so if you have money in passive financial investments, you're largely at risk right here. The government basically has a bullseye on your money, and you're incredibly at risk through these passive financial investments. If you have money in them, now's the time to take some profit and start figuring out how do I start positioning that money more effectively. As interest rates go up, there's some financials can benefit from the spread because they can charge more in that environment. There are, one of the things that has been talked about in the tax plan, and who knows what's going to be implemented, is that there's a potential they may remove an interest deduction for businesses. If an interest deduction is removed, there's going to be less incentive for people to finance with debt and more with equity. And so without that, if there is a change to the deductibility of interest, that's going to have a big impact on companies that make money by lending to companies. And real estate investments, as interest rates go up, generally tend to be impacted negatively. The stronger dollar, it's great for us as consumers to have a strong dollar. And so international investors, you can take your strong dollar and go somewhere else and buy property in Colombia and somewhere else where you think that there's going to be opportunity, wherever. So there's a benefit to you as an international investor. If you're an importer, you can bring more stuff in. If it's a strong dollar, there's a big negative for exporters. And so this is where you have to figure out, where do I fall on this, and where do the companies I'm investing in fall on this? As we reduce the labor pool, I don't see how any company benefits from that, because what that's going to do is drive up the price of labor, increase your costs, and particularly for technology, there's going to be less talent available, and more important for you, there's going to be fewer lifestyle services available. Folks that cut your hair, to do your lawn, clean your house. There's going to be fewer people available to do the stuff that right now you may have someone else do. So there's a major impact on how you're operating. If we get in this environment where consumer prices go up, generally the only industry that benefits from that is consumer staples. This is basically, people are going to buy what they need to survive. Groceries, cleaning supplies, they need that stuff. Everyone else is going to be impacted negatively because it's going to drive expenses up, because every company and every individual is a consumer. And so as consumer prices go up, there's a huge negative for everybody except for consumer staples companies. Asset inflation, great potential with real estate, great potential with business ownership. With asset inflation, a huge negative for financial assets. So again, if you've got significant money in passive financial assets, you need to extract it from that and start moving it into more productive uses, more productive opportunities. And so now we're going to transition from, we've kind of sketched out what others look at for opportunity areas, and my analysis and what the market says about where they think things are going. And now we're going to start putting it into effect for you. And this is the active investor success planning I work with my clients on and help them build a success plan and work on an active basis to help them achieve this. And one of the things we'll get into is how do we do this in a tax smart way. And so one of my books is Plan to Not Pay Taxes, and that identified a number of strategies you can use to start benefiting from the U.S. tax code, which allows you to not pay taxes for the second half of your adult life. And so here's the structure of my personal business. And what I want you to do is basically build your own structure in a similar fashion. Something where you have an overarching mission, success plan identified, and then in this case, the Business Godfather focuses on startup businesses, angel investments, cash flow businesses, as well as developing intellectual property. Ally Homes focuses on real estate. Online Trading Academy focuses on financial trading. Those are your 5 basic business models. You don't have to do all 5 of them. You may focus on 1 or 2, depending on what your comfort level is. But as you build out your success plan, those are the tools, those are the Lego building blocks you have to work with. And so one of the things I do is I work with folks on developing that success plan, and part of it is just realizing that what you think success is different than everybody else. And this is an area where you don't want to copy off someone else's paper, where you want to make sure that your success is defined by you individually and what you're trying to accomplish. And so part of it is just identifying that. And then once you have identified kind of your overarching goals, then it's identifying, what's my foundation? That's the preservation strategies. These are strategies that give you peace of mind. They let you sleep at night. They're kind of your in case of emergency break glass strategies. And these are things, maybe you make between 0 and 6% on those. This is where passive financial investments are appropriate in your overall plan, if that's something that you're still willing to do. But that's your foundation and your bedrock, and if everything else doesn't work out, at least you have this to fall back on. But one of the most underutilized areas we see, people have way too much money in preservation. And you're an active investor, you've got skills, you've got the ability to create opportunities and grow wealth double, triple, quadruple digit. This is where we want to use that for income opportunities and wealth opportunities. And so the income opportunities are there for a shorter term, cover your monthly expenses, and develop multiple strategies related to cash flow. The wealth strategies and wealth creation is really for kind of longer term, bigger ticket. These are your opportunities to really create significant wealth going forward. And so all these factors work together. And as we build the success plan out, one of the things, my perspective is I don't want to have just a plan A, because plan A may stop working. So you always want to have a plan B, but I have enough experience to know that sometimes plan A and plan B don't work, so I also need a plan C. So my perspective is you want to have at least 3 preservation strategies, 3 income strategies, and 3 wealth creation strategies. And so this is something I work with my clients on, that they're doing this within their business, but also in their personal financial business. And so for you, we've identified a lot of types of businesses. Part of the answer to this is using your own particular expertise, your own experience, your own network of figuring out where do you want to start positioning your money. Because part of your mission should be to extract your money from unproductive investments and move it into more productive double-digit, triple-digit, quadruple-digit opportunities. And as an active investor, you have the skill, you've got the capabilities, you just need some motivation and focus to make that happen. And so building that success plan out will help you, start developing multiple approaches to generate that where you want to go. Now, some of the preservation strategies that are out there, one relate to currency. There's the global currencies. We talked about the Australian dollar benefiting from the growth in China. Just exposing yourself to those opportunities. Right now, if you're 100% exposed to the US dollar and the US dollar goes up, that's great. But what if the US dollar goes down? If the US dollar gets weaker, that's really bad for you. So the preservation strategy lets you hedge that and preserve some of your purchasing power. There's also opportunities in cryptocurrencies like Bitcoin, and there's a number of other currencies out there. Some people, that's an attractive way for them to protect themselves. In China, they're one of the primary users of the cryptocurrencies. What they've been doing is shifting their wealth into cryptocurrencies so that they're less subject to the Chinese government. Another great preservation strategy deals with real estate. And it could be domestic, could be international, depends on how you want to use that, use the strength of the dollar to your benefit or not. Then there's the practical side of being able to manage it and manage it effectively. And so, rental real estate is something that many people have in their portfolio. Something to look at, if you want to expose yourself to a particular market, there may be opportunities internationally. And so, I visited Colombia, Cartagena a few years ago, and you could get a condo on the beach for $60,000. And you could rent that out for about $100 a night. And so it could be a very effective way for you to, give yourself some upside in the event that Colombia continues to grow, but in the short term also generate some income using that asset effectively. Financial hedging, using futures, using options. This is where, from a preservation standpoint, in life, you take certain positions, right? If you drive a car, you are naturally, you short gasoline, which means that if gasoline goes up, you lose money. If gasoline goes down, you make money. Just in your personal life, you have exposure to different financial moves. There's things you can do in the financial markets to protect yourself against that. And if the price of gasoline goes up, if you make money in your financial accounts to offset the costs in your living accounts, that's a way for you to protect yourself. So financial hedging gives you some great opportunities both in your personal life and across a much broader spectrum. And another preservation strategy is using commodities or collectibles. And this, again, goes to your own particular passion and what you enjoy doing, but it may be a place for you to put money where at least it's going to be it's something that you'll be able to turn into something in the future. Income strategies that I see as our best opportunities in the current environment. Number one is financial trading. And this is where giving yourself the opportunity to take your assets, leverage your assets, do it in a high probability where you're getting more reward for the risk financial trading for futures, financial trading for Forex, and options are a significant way for you to start generating consistent income going forward. And so at the Online Trading Academy, this is what we help people do. There's an opportunity here for you to fit this into your schedule. It could be 2 hours a day, 2 hours a week, 2 hours a month, but there's a way for you to use your assets in a more effective way with less risk than what you're currently doing and with a more consistent return. So financial trading is the #1 income strategy. Second are cash flow businesses. And this is, again, goes to your individual expertise, your individual, interest areas, but getting in a business where you can generate cash flow, what we want to do is make sure that we're generating enough to meet your individual cash flow goals. And so if we have those, we had talked about the 3 strategies, A, B, and C. Each strategy is trying to meet your monthly goal. And so if your goal is to make, $5,000 a month or $10,000 a month, Plan A is designed to make that money. Plan B is designed to make that. Plan C is designed to make that. If all of them succeed, then you're making way more money than you need. But what we want to do is build a plan where you don't have to be perfect and still get where you want to get to. Third item is real estate and exposing yourself, whether it's domestically or international, beyond preservation, but actually generating income on a consistent basis. These are your 3 best strategies for income as an active investor. For wealth strategies, and this is where the real upside is. To me, I think angel investments and startups, particularly for people that have been engaged with businesses and built successful businesses, you have the skills, you have the know-how, you have the comfort level with risk, and it's taking your specialized knowledge and your expertise and applying it in a way where you can grow your wealth and also help others do that. So the #1 wealth strategy is angel investments and startups. #2 is developing intellectual property, taking that specialized knowledge and putting it into a way that you can generate income from it and grow wealth. If you're a software programmer, this is really what most technology companies do. They're making money from the intellectual property. Financial trading, also a very good wealth strategy, and using the futures market, using the Forex market and options market, and building businesses, U.S.-focused manufacturing and services. This is one where clearly the government is in favor of it, and you're going to be able to benefit if you can build a business that you're using U.S.-sourced products, U.S. manufactured products, and U.S. used products. And then a 5th wealth strategy is removing yourself from the U.S. economy and developing international businesses, but using the cloud, using the great opportunities in the financial markets going forward. So those are your basic preservation, income, and wealth strategies that I see for you as an active investor, or where you should be focusing your success plan going forward. Then, once we have that, then we want to take a look at how can we do this in a tax smart way. And so the wealth diamond is a concept I developed a few years ago. And it's about, understand that there's 4 ways that we can hold money. We have money in cash, taxable, tax deferred, and tax free. And so on the cash side, taxable side, that's what most people focus on. Tax deferred, this relates to your IRAs, 401ks, TSP, thrift savings plan, 403b. Most of the passive financial investments are held in tax deferred accounts. We also have the opportunity to build wealth tax free, and that's tax free from the age of 59 and a half to the end of your life. It could be 90, it could be 100. Basically, the second half of your adult life, you can be living tax free with each of these investments: your angel investments and startups, your real estate investments, your intellectual property investments, your cash flow businesses, plus your financial trading. And so this is, once we start building that success plan out, then we can start really positioning ourselves to take advantage of what the government says is absolutely A-OK for you to do, is develop tax-free strategies for the second half of your adult life. And so it's incredibly powerful. It does take some planning, it takes some patience, but it also gives you the opportunity to not pay taxes for the second half of your adult life. Pretty cool, pretty powerful, And that's part of really mastering, being an active investor. In the book, the Plan to Not Pay Taxes book, one of the areas I talk about is, there's a tax haven. People used to come to me all the time and say, how do I not pay any money in taxes? I say, that's easy, just don't make any money. In this case, some people are looking for tax havens, but what's happened basically since 9/11, all the international tax havens have been under assault by the US government, and they've been under attack, and most of their benefits have gone away, right? Even Panama was a US tax haven, all the stuff got published, there's no secrets anymore. What's happened is that Puerto Rico is within the US sphere and within the US world as a territory. However, it's outside of the US income tax world. And it used to be, Puerto Rican taxes were high. However, what they did back in 2012 is they created some ways to attract capital, attract active investors to Puerto Rico. And so you can position yourself where you have tax-free opportunities, tax on interest, 0%, tax on dividends, 0%, tax on capital gains, 0%. There's certain businesses that get tax-favored transactions, service businesses, 4 or 6%, and really negligible tax rates for folks. And you have to be, a resident of Puerto Rico. You basically make a contract with the Puerto Rican government for 20 years, so you can lock that in. But it's an incredible opportunity. If you have some mobility, if you don't mind spending, 190, 200 days a year in Puerto Rico, then you can fly to the US, take care of your business, go back and live tax-free. So incredibly powerful if you have the flexibility. It's the last legal tax haven. It's allowed to function because it's within the US sphere. And so while we're cracking down on every other tax haven, there's some great opportunities in Puerto Rico for you to take advantage of. As we're going to build startups and as we're going to look for good cash flow businesses, we need to become students of innovation. And for me, when I'm looking at a company, my basic framework is I'm looking for a proven innovation that's being applied in a new industry. Right? Some folks call it the blue ocean strategy. You want to go somewhere where there's no competition. But more importantly, if you look at successful companies, generally they're taking something that has proven to work and they apply it in a new industry. And as you're evaluating your startups, as you're evaluating your angel investments, this is a great frame to look at them. And I'll tell you, 90 to 95% of companies that are looking for money don't fit this. And you've got to ask yourself, why on earth would I put money with them? But even in the venture capital folks, the private equity folks, they fall into the trap because they have money, they want to put it into action. This guideline will help you do it in a more effective way. Demographically, we always want to have macroeconomic forces at our back. And so, in the 20th century, there was about 1 billion people engaged in the global economy. The 21st century, it's more like 3, 4, 5 billion people engaged in the global economy. And so with that, as people are starting to benefit from the global economy, there's demand for better food. There's demand for clean water. There's demand for energy. There's demand for health care. Those areas are things where opportunities that are created in that are great for you in the, because you have the demographic forces at your back. Also in the US, the baby boomers were a significant generation. The millennial consumers are actually bigger than the baby boomers and have the potential to be more significant than the baby boomers going forward. So focusing businesses on them as they go through the different life cycles, we've already seen the model work with the baby boomers. You can apply the same model or similar models with millennial consumers. Great opportunities for you to tap into this new market that engages in a different way. Geographically, opportunities in Australia, Africa, and the Arctic. I think those are areas that you could benefit from learning about. If you have a proclivity for any of those areas, then take advantage of that. There's going to be growth opportunities and significant ways for your preparation to meet opportunity and be successful. In the technology sphere, everything relates to big data, whether it's platforms, whether it's blockchain technology, everything is like, what do we do with all this data? Blockchain is the technology that supports Bitcoin. And so what's happened is, Bitcoin has its own universe as a currency, but the technology is actually incredibly powerful for other things, for security, for things like land records, for any type of record keeping. You go to most countries. In the United States, our land records are all on paper and they're all sitting there at the courthouse. Other countries don't have that. And so a lot of times the records have been burned, so nobody knows who actually owns anything. There's going to be great opportunities for blockchain technology companies in the near term. It's a proven technology. We're just looking for how can you apply that in a new industry, in a new area. And then on the service side, and this is something that's always going to be there. One of my favorite books is called Selling the Invisible, and it's from the 80s, but it's still, it's worth your read now. And it basically starts from the proposition that no matter where you are, service sucks. And if you're in a service business, you just have to suck less than someone else. And so this is part of, as you build your business, if you can just focus on improving the service, improving the experience, people will be willing to pay a premium for that. And so that's one of the things that's guiding the Ally Homes home remodeling company, is to provide that extra level of service and make the home remodeling, which is one of the worst customer experiences, into a less bad one. And that's where, as you build these companies, as you're looking to build out your active investor framework, this gives you some tools to figure out where should you focus your efforts and what kind of startup should I spend my time with. So now it's up to you, right? On your mark, get set, and go. Get yourself going. Take advantage of these massive opportunities. And remember, we talked earlier in this presentation about the magnitude of the opportunity. I don't believe we've had the magnitude of change and the magnitude of opportunities to generate income and wealth in our lifetimes that we're going to have over these next several years. And so part of it is wrap your brain around that. I've given you the areas to focus on so you can see where are things going and what opportunities you might have. And third, I really want you to prepare to make more money than you made your entire life. The opportunity is fabulous. You just have to apply yourself, apply your assets in a more productive fashion. And so if you're interested in immersing yourself in this active investor mindset and active investor approach, there's a number of resources we have. You can connect with me on LinkedIn, activeinvestor.us, where we have some of these materials. Active Investor LinkedIn group page, where we share a lot of the materials. And if you're interested in the financial trading, you can go to tradingacademy.com/Washington, D.C. And there's a number of resources there. We have sessions on a regular basis. But the goal here is to help you get a different mindset and take advantage of these massive opportunities around you. Because the opportunities are going to be phenomenal. The key is, are you able to take advantage of them? And so in that respect, one of the things that we're establishing is an active investor group. And it's basically a club for people that want to become better active investors. And I know there's all sorts of groups out there, CEO management groups, there's networking groups. The goal here is to get a bunch of like-minded people together that just want to make more money, that want to do better with their skills as active investors. And so it's a membership club, and the goal is to help you make more money and grow your wealth as an active investor. And so you'll have, as a member of the club, you'll have access to resources to help manage your multiple businesses. We will focus on the tax-free, tax reduction strategies, and we'll go and actually be looking at active investor opportunities on a regular basis. So how do we do that? Every person that's a member of the club, I'll sit down with you and help build out a success plan. And in that, we'll identify what are your goals and start identifying some preservation strategies, some income strategies, and some wealth creation strategies that make sense for you. Then what we'll get into is how do we develop a strategic action plan to put that in effect. And so the strategic action plan is what I use with my clients to help them move forward and grow wealth in their business. And part of the Active Investor Club will allow you to start understand how to do this yourself. And then on a monthly basis, we'll have a session focused on seeing how well you're achieving your strategic action plan goals. We'll also have opportunity dinners where we'll be evaluating the active investment opportunities in whether it's for startups, whether it's real estate opportunities, angel investments, cash flow, or even financial trading. The goal is to open your eyes to opportunities that you're not currently seeing and see how you can adopt that into your success plan. And then on a regular basis, we'll have education sessions where we're going to talk about active investing and how to do it better. And there's never been a better time to be an active investor. So we're having an information session next Friday, May 5th at 10 a.m. in Tyson's Corner. We'll also have plenty of materials available over the next several months. We're going to get started with the Active Investor Club in June. And June 2nd is our first meeting. We have 3 sessions scheduled in June, 3 sessions scheduled in July, 2 in August, and they're going to follow that. They're going to follow that basic structure. There'll be educational event. There'll be an opportunity event. There'll also be a success plan event. And so this is where for you figure out how that fits in. You'll also get access to online resources. So if you can't make it, because one of the things that we've learned is that it's very hard for people to actually come to an event. That's why we're doing this through YouTube, and we're going to basically able to have materials available to you so that you can consume them on your schedule and consume them at your convenience. So the Active Investor Club is something that we've developed based on what people have told us they want. And so if it's something you're interested in, hit me up on LinkedIn, send me an email, chris@businessgodfather.com, and we can start the dialogue and see if being a member of the Active Investor Club is a good fit for you. So I know we have the session, and if folks have had some questions, more than happy to answer them. So
Scott Schaefer asks, where would you put your money right now if you want to seek medium growth?
So Scott asked me, where would I put my money right now if I want to seek medium growth? And my issue is, what does medium mean? And one of the problems for people is that, for medium, is 3% medium, is 5% medium? I don't want to focus on any single-digit strategies, right? Leave that for other folks. As an active investor, we should be looking for double-digit, triple-digit, quadruple-digit opportunities. And so if we're looking at double-digit opportunities, where a lot of folks are going is real estate. Generally real estate will grow at about a 6% per year rate, but then we can get cash flow benefits through rent and also through amortization and stuff like that. So that's basically, I would consider that not a medium return. I'd consider that kind of a low return, but we're looking for double-digit returns on the low side. From there, then it really goes to your particular skill. And so when we looked at the income side, financial trading gives you great opportunities, and that's where you can say, no, I want double-digit returns, I want triple-digit returns, and that's where you can kind of balance your goals and figure out what are you trying to accomplish in your active investing success plan. So, all right. Well, thank you everyone for joining me, and I hope this was helpful for you. Start getting you into the active investor mindset. And for those of you who are motivated and focused, we look forward to having you join us with the Active Investor Club starting in June. And you're welcome to stop in next Friday, May 5th in Tyson's Corner, 10 a.m., where we'll talk more about the specifics of being part of the Active Investor Club. If you can't make that, just reach out to me on LinkedIn, and we can set up a call and get you being more productive going forward. Thanks for joining us.